Anthony Grasso here, bringing you financial news you can use. In this video, I'm going to do a stock analysis on Senseonics Holdings. Is this meme Reddit former penny stock short squeeze still going to the moon and worth investing in? Well, let's find out together. I'm going to go over a summary of the company, its product offerings, recent headline news, financials, analyst projections, and give it my buy, hold, or sell recommendation for both your short-term and long-term growth investors out there. And as always, folks, don't forget to smash that like button down below and consider subscribing. Hit that notification bell if you'd like to hear daily stock reviews and recommendations from an unbiased source. So let's get right into it. So Senseonics Holdings is a medical technology company, develops and commercializes continuous glucose monitoring systems for people with diabetes, primarily in Europe. Its products include SENS and SENS XL, which are implantable CGM systems to measure glucose levels in people with diabetes for a period of up to 90 and 180 days. So let's go ahead and look at some of the news of the company right now. So back at the end of January, Senseonics Holdings announced a closing of $115 million deal offering of common stock. The company intends to use the net proceeds from this offering for general corporate purposes, including product development, focus on working to complete clinical development, secure regulatory approvals, and support anticipated commercial launch of the 365-day product, supporting the collaboration with Sensia Diabetes Care, and funding working capital and capital expenditures and business plan. Now, the company believes that its existing cash and cash equivalents will be sufficient to fund its business through cash flow break even from operations. And then back in December, it was announced by the company that that Senseonics had a 180-day SENS glucose monitoring delayed by the FDA from the COVID-19 pandemic. So Senseonics plans to roll out its new long-term diabetes sensor implant will be pushed to the middle of next year, so second quarter of 2021, as FDA reviewers continue to be swamped by product submissions aimed at the COVID-19 pandemic. Now, the upcoming version of the Senseonics SENS continuous glucose monitoring system, a smartphone connected device, first approved in June 2018, that's inserted completely under the skin, aims to double its lifespan from 90 days to 6 months. So this is something that's already been approved by the company, by the FDA, but this is a new version of it. But the company has received word from the FDA to expect delays of at least 2 months for its application, while the agency tasks its staff with emergency reviews of coronavirus tests and other medical devices, it said. So let's go ahead and look at some of the fundamentals of the company. So the company has a market capitalization of around $2 billion right now. The company's revenues are projected to be $4.5 million with a negative $89 million in earnings for 2020. Revenue is forecasted to grow about 52% per year. Now, even though the revenue is forecasted to grow, the company is currently unprofitable and is not forecasted to become profitable even with this approval over the next 3 years. By 2025, it is projected to have revenues of around $158 million with a negative $10 million in earnings. Now, shareholders have been substantially diluted in the past year, and there is negative shareholder equity. So negative shareholder equity is a red flag for investors because it means the company's liabilities exceed its assets. Now, but are they in a good financial position? Well, they have sufficient cash for at least a year operations or more, since they just diluted their stock even more. But the balance sheet is very weak. Now, highlighted about its negative owner's equity, most likely this was caused by cumulative losses which negatively impacted retained earnings. Additionally, the company's debt load outweighs its assets while day-to-day operations are losing money. One plus is that there's enough liquid assets to satisfy current obligations. However, this situation is unsustainable over the long run. Now, it definitely has a lot of financial risk in the future. And the insiders have only sold shares in the past year. So let me bring it back here. So what do the analysts say about this right now? The current analyst consensus is a buy and a hold. That was a few days ago, actually a month ago. The average stock price target is only 92 cents a share, with a high estimate of $1 and a low estimate of 70 cents a share. And it's all the way up to $4.62 right now. So now we can see the stock price is completely disconnected from the fundamentals and the market capitalization on where it should be. Now, going over a few of the analyst reports, now a lot of them had some old reports, but the CFRA report has the company as a hold, and they did that a couple days ago. So my buy, hold, or sell recommendation on Senseonics Holdings, here are my thoughts. Now, the short interest on the company as of February 9th was about 25%. Well, that was like 34% as of a week ago, and it's 25% as of yesterday. This is one of those short squeeze stocks completely disconnected from the fundamentals. Now, if you look at the valuation analysis, the price to sales ratio is the most appropriate valuation measure for this company. The PE and the PEG ratios are not meaningful due to the company's negative earnings right now. Therefore, the company seems highly valued with a price to sales ratio of 520.16 times, one of the highest in the healthcare equipment and supplies industry. Yes, that was a 520 times. Now, looking at the profitability analysis as well, based on the gross operating and net margins, the company has a cost structure that eats up a percentage of its revenues that is among the highest of any company in the healthcare equipment and supplies industry. To make matters worse, the company is losing money on an operating basis. Now, you must understand this, that a short squeeze is being played on this stock to hype up the stock to the moon with a current market capitalization of between 1.8 and $2 billion. That is beyond reality right now. It is in imagination land. Now, over the past month, investors have witnessed a one earnings estimate revision lower compared to none higher for the current year. Now, the consensus estimate for the company has been on a downward trend over the same time period too, as the estimates have fallen 7.1% over the last 2 months. Now, Senseonics' recent popularity has catapulted the penny stock into the mainstream med tech conversation and has gone from one of Reddit's meme stocks to a $1.8 billion market capitalization stock. Now, Senseonics has already announced that it expects to receive that FDA approval for the SENS CGM glucose monitoring system by the end of the second quarter of 2021, which accounts for a lot of the stock's recent success back in January and February. Now, the company is also predicting net revenues of only between 12 million and 15 million for all of 2021, based on its current base and planned transition of its international commercial and sales agreements from Roche to Essentia Diabetes Care. My recommendation for long-term growth investors is to avoid this company right now. There is too much downside risk than any upside potential going into the future right now. My recommendation for short-term investors is an exit strategy before this stock falls back to the earth. Now, the bullish case argue that one of the main reasons that this company has been popular penny stock amongst traders is the impeding FDA approval of its continuous glucose monitoring system. Now, the SENS CGM system is thought by many to be a disruptive form of technology in the ongoing fight against diabetes, one of the most devastating commonly diagnosed diseases in the United States. Rather than intermittently testing blood throughout the day, the new SENS CGM system places a sensor beneath the patient's skin and updates it with a smartphone app every 5 minutes. Now, if approved, it will save diabetes patients hundreds or even thousands of needle injections per year for blood tests. Now, even with a great technology like that, the projected revenues and unprofitability for years should bring this stock back down to earth soon, because the analysts have already factored in those projected revenues over the next 4 years, and I went over that just a few minutes ago. Well, what are your thoughts? And please comment down below your revenue projections you have for this company that have already been calculated by the analyst on the glucose monitoring system that is expected to get FDA approval. And based on that, what market capitalization do you put this company at? Because right now, it's completely disconnected from any of the fundamentals. So there you have it, folks. And as always, don't forget to smash that like button down below and consider subscribing. Hit that notification bell if you like to hear daily stock recommendations and reviews from an unbiased source. Until the next stock update video later today, folks, ciao.